All right.
That always takes a few minutes. Hi, Kristen.
Hi, how are you?
Good. Okay.
Hi, Kristen.
Hi, how is everyone?
We are live and recording.
Okay. Is Christina on?
Hi, Lewis.
Hey, Christina. I didn't see you. How's everything?
Oh, yeah, you can't see me right now.
Okay.
What's going on?
We don't need to see you right now.
No.
Okay. All right.
Oh, okay.
Did you see it, Lewis? Did you see me?
No, I don't see you. I just see.
Oh, okay. Well, Kristen saw me.
I saw you.
Oh, okay. Well, are you ready to start, Christina?
I'm ready to start. Are we live?
We are
yes,
live.
ma'am. We sure are. They're waiting to
Oh.
see you.
Dang. Kristen, was I live on a Lord have mercy?
Sorry. It was quick though. It was quick. It was quick. It's fast, quick, and hurry.
So, welcome everyone to today's meeting. I wanted to open the meeting up for the investment committee meeting for this month. Sue, if you would do us the honors and have a roll call vote.
Sure. Angela Banks. Here. Christina Bennett.
Present.
Joseph Clark. Lewis Cross.
Present.
Regina Fowler.
Present.
Sheila Goodwin. See you, Sheila. Donna Jones.
Here.
Yvette
Sheila Goodwin is here.
Okay, thanks, Sheila. Yvette Levy.
Here.
Bobby Richardson.
Present.
Albert Sanders.
Here.
And Justin Stein. All right. So we have 9, so we have a quorum.
Thank you, Sue. At this moment, I'd like to transfer the meeting over to Kristen so we can start with the flash. And then Kristen, after the flash, if we could go into the private credit recommendations and then finish up with the watch list, if possible.
Yes. So, okay. Yep. Sue has it up. So thank you so much. This is going to be relatively quick because we are seeing similar to what we've been seeing. So somewhat volatile markets. Maybe we can turn straight to the performance because I know we've spent a lot of time on performance. Okay, perfect. So, and yeah, thank you. It's a little small. So what you can see, you know, again, for the 1 month number, you are looking good. You're about 100 basis points or 1% over the policy index. So that is right lockstep. Your fiscal year to date, again, 1.9 versus 1.3. Where you see that you are not as strong is at your 1 year and your 3 year and your 5 year. So that story continues to be very similar to what we've talked about. Your growth managers have done very well for you, and your value managers have done well for you. However, they have not necessarily kept up with the benchmark. That said, the benchmark, which is typically the 50th percentile, that's where we normally would see it, has been outpacing active managers. And so so that's what we see. So if you think of your, let's go to your total domestic equity and you scroll over to your 1 year, the 1 year you did 34.1%, which is outstanding. These are returns that we don't typically see. Our expected return, as you remember from discussions, is around 5% for U.S. equity. So we're at 34.1%. So your managers did what they were supposed to do, and they did it in a manner, in a way that has an eye on risk. As a reminder, the index does not worry about risk. They just have kind of a catch-all. And they don't have to worry about sort of putting together a portfolio that really is in line with risk mitigation mindset. And so the Russell 3000, which is the all cap index, had 30, I'm sorry, my screen, I think, let me look at mine. Is that 30? I might need to look at mine just to see. My apologies, I just couldn't see it that good. 35.3. Okay, sorry, I got on a screen that was a little larger. 35.3. So that just gives you some perspective. So that's really what you have been seeing going on. So there's nothing broken with the portfolio. There's nothing broken with the managers that you have in place. Managers like Edgar Lomax have trailed a bit. You can see at that 1 year number, they were 12.5 versus 22. Still giving value add. But I have to remind you, a year ago, they were your top performing manager. They were in the top 1% of all managers. So again, they are value in nature. So it was really quite surprising that over the last several years, given the growth market that we've had, that the value manager that Edgar Lomax was able to keep up and do as well as they have done. So I don't know if you have any specific questions, but I just wanted to kind of give you some feedback on your 1 year number, which does flow through. We will be looking at the watch list in a moment, but maybe Sue, if you could keep.
Hey, Kristen.
Yes, ma'am.
How do the fees for the active manager versus the index play into them not keeping pace?
Well, the fees, you do have a higher level of fees with active managers. Your index funds are going to be anywhere from 4 or 5 basis points. So that's 0.05% as an example, versus your active managers can be 30, 40, 50 basis points, depending on what asset class. So typically we would like to see your active managers do better. There are periods of time, which we have been in recently, where the index has done outrageously well. We don't anticipate that is going to go, on and on. And in particular, when you look at the smaller cap names, non-US, emerging markets, those are areas that typically we really like to see active management, because there's more discerning. When you think about a fundamental manager that's able to, do that down, really be able to delineate between companies that are just riding the wave versus companies that are going to be able to have persistent and consistent value over time. And then there's the risk component. So again, the index, has thousands of names in it, right? And so they're just throwing everything in the kitchen sink in. So that component of really discerning from a risk standpoint isn't there from the index. So when the bottom falls out, it's going to fall out on the index. The hope is, as an example, I used Edgar Lomax. When the bottom was falling out in value stocks, they were still able to ride above. That was their skill. We call it alpha, but that was their skill as a portfolio manager coming into play.
Just for clarity, can you tell me the difference between 1 year and fiscal year to date? Is 1 year through 12/31/2020 and the fiscal year of this plan?
Absolutely.
Okay.
So, yep. Fiscal year to date is 6/30.
Okay.
So we look at it both from your fiscal year to date, but then also want to look at it as a calendar year.
Okay.
And nice to meet you, Regina. I don't think I've met you before. So.
Thank you.
So maybe we can move on, Sue. What you'll see when and I'm gonna focus more on your 1 year, just because That's a little bit longer of a time period. We know things can change in between, but you look at that 47% in your small mid cap. I mean, these are sort of shocker numbers, if you will. And if you look at the Russell 2000, which is going to be small cap. I apologize. You're all working from home. Hopefully y'all don't hear that too much. Small cap, you see the 51% there. So again, same story as it relates to the index. It's just been flying high, extraordinarily high.
Do the fiscal year to date numbers indicate though that the market has gone down considerably, and this year to date, or 2021 year to date, we can anticipate a much lower year to date 1 year number?
Yes, I mean, what happens is you have the good and the bad. So the 1 year that you see right now, this is going to, I don't know what's going on here. This 1 year is going to take into consideration the markets fell apart in March, as we remember, but then they came back like gangbusters. And so that's something that we are obviously looking at, but as the good numbers roll off, additional numbers roll on. So yes, these numbers that we have seen are completely unsustainable. I mean, this is it's wild. It's great. We take it. It's helped your plan grow, but that is not something, as I mentioned, our expected return over the next 10 years for equities is 5.5%. Fixed income, 1%. So I would say that it's almost like we've robbed from the future these type of returns. And so we will see lower returns. There's no doubt about it. But the goal is obviously to stay around the 7.5% number, if you will. That gets over your bogey. And so that's what we really look to manage towards. It's great when we get these kind of numbers, but we really want to manage towards that.
And what we also want to focus on, Kristen, is that the returns, while they're not meeting the benchmark, they're still positive. And we would have taken these positive 8% or even, a 3%, 4% a couple years ago in this category. So, it's looking at the totality of our returns over time. Because I remember Bobby a couple months ago saying, "Why are all the numbers negative?" And here we are looking at these with great positive numbers that we know is not sustainable.
Mm-hmm. So what you can see when you look at the international has done well, not as well as the domestic managers. So we've actually, believe that there's going to continue to be some positive returns in the U.S. market. Last year, this time, we were starting to think that the U.S. was having its day, if you will, and they were, on its way, where non-U.S., because the balance sheets in particular on emerging market equities are stronger than they are in developed markets and the U.S., but the PE ratios and the momentum, as well as interest rates, continue to show now that we've moved into what we're going to call sort of a virus trajectory from the pandemic, that the equity market U.S. equity market is going to continue to do well. So, when we look down at emerging markets, again, not as good as the non-U.S., but again, 33% is outstanding. And so we've just seen some strong numbers across the board. Invesco and DFA being more of a quantitative manager, Invesco also pulling in a little bit of that value component to it, but 33.5, I mean, just, again, while they may be trailing the benchmark, these numbers are just so phenomenal that I don't want to get too caught up on the fact that they just didn't meet a benchmark that's really at this point trading in the top decile, because that's an anomaly. We can move on, Sid. Now, when you look at the total global X, that's going to include both US and non-US. So it's going to be somewhere in the middle, if you will. So you see for that 1 year, 29%. Again, Exponents has done well, still didn't quite meet the ACWI, which stands for All Country World Index, and at 30.2, but very close. And so in this case, back to Angie, your comment around the fees, we are paying fees, you know, on top of these active managers that are a little higher than what we would pay for index funds. But again, these are areas that normally the index would have been in the 50th percentile. And because we're looking at a flash, you can't see where the percentiles are, but normally when you have your quarterly, you'll have a little number behind these numbers, like 1 year, like 29.4, and then you'll have like in parentheses, another number which will show you where it is from a percentile standpoint. And that's kind of how you can determine what's going on with the index. So we can move forward. Fixed income. So fixed income has been a little dismal, as you can see, poor performance or low, I would say absolute performance being somewhat negative across the board until you get to your 1 year number. 1 year did well. Areas like emerging market debt, high yield did well over the last year, but TIPS and Barclays Ag didn't do as well. And that's really the sort of the nothing's riskless, but it is, you know, the standard meat and potatoes fixed income. You know, we did add the TIPS, which did do nicely on the 1 year. Where you saw a bit of pickup would have been in your absolute return fixed income. And so again, that's going to have a little bit more gump, if you will, as it relates to the fixed income instruments that they're going into, a little bit more variety outside of just core bonds. You also saw that along with your multi-sector, which Neuberger Berman on the 1 year. So those were nice pickups. And then of course, emerging market debt blended, and that's going to be blended local and US dollar denominated currencies. We do a blended approach while local has an estimated return profile of being stronger. From a risk mitigation standpoint, we're looking at it from a blended, and that's why we've implemented that, just to make sure that we're balancing that out, as well as you have the currency effect, because we would then, you know, we do operate in US dollars. So at 8.5% for fixed income, that's not bad, right? So, and actually fairly strong. Again, when we start to look at the expected returns over the next 10 years, that fixed income number goes down. Core and TIPS are about 1%. So that's another reason why we continue to have a diversified portfolio where we can have areas like credit that are going to do well. We're going to be talking about private credit. Private credit will get you anywhere from like high single digits to low double digits. And we are incorporating that. We are picking up the illiquidity premium, and that means your money is tied up for a little bit longer to be able to get a bit more return on the credit fixed income side. So again, just giving a little more background to those that are a little newer to the board. So maybe we can keep moving. Your GAA. So GAA, I know we have a couple of other presentations, so I wanted to just give guidance today. We are sitting at about 5.6% in GAA, and if you look at your portfolio, it's broken down to Mellon, GMO, and PIMCO. We don't need all three of those managers. We could go down to one manager. PIMCO remains on our preferred list, a strong manager that we have a lot high conviction in. Mellon has rolled off and GMO has rolled off. And so while they're have done decently in your portfolio, we just don't need the three managers. And just for background, as a reminder, we were at about 5.6%. We were closer last year to about 12.5%. And so we reduced that. Once again, to give you a definition of GAA, global asset allocation, it basically takes the handcuffs off the manager and allows them to go in a lot of different areas. And that is beneficial when you think of the pickup that you can get from being tactically allocated to various areas. That said, we instituted this you know, over 10 years ago when the portfolio had what I'm going to say less complexity. And what I mean by less complexity, you had less asset classes or a lower number of asset classes. You didn't have the level of hedge funds. You weren't included in some of the real estate areas, as well as, you know, we've included more on the private equity side, emerging market debt side, high yield side. So those dedicated allocations allow for us not to have the need to have such a high GAA allocation. Again, GAA also has the benefit of being able to move very quickly, so you don't have to go into RFP. So at this point, I'm not saying we need to eliminate it, but we definitely wanted to bring that down. And now that we've brought that down, the need to have 3 managers is not there. So again, we're at about a 5%. We're a little over right now, but let's say about a 5% allocation is what our target is. At this point, I would be comfortable with you going to 1 manager. However, if for whatever reason you're not comfortable having 5% in 1 manager, you have historically felt more comfortable with having a lower number. That it's nothing wrong, but just characteristically or culturally, I should say, I would then go to 2 managers, and those would be PIMCO and GMO.
So Kristen, did you say that Mellon and GMO are no longer on the preferred list?
Yes, I did say that. Now,
So is there another GAA manager that would be on the preferred list?
there is, and we could evaluate that. I don't know that it's worth the process to go through to try to find, you know, I mean, GMO is still an extraordinarily strong manager. Okay, so I don't want to give the impression that GMO is not a good manager. All I'm saying is that PIMCO continues to be the highest level of conviction, and so as we're trying to consolidate, that would make the most sense. But we could do a search. I just think that there's other areas that you may want to spend the time that you're going to get more pickup, if you will, if that makes sense.
So Kristen, would it benefit us to see if we have the opportunity? Do we have any minority managers in this space that could complement PIMCO?
No. This is a global mandate, and typically, no, we went through, yeah, no, I don't know of any diverse managers. There's most diverse managers still are typically more on the dedicated searches, and we're just now moving to see some managers in the emerging market equity space and global space, meaning just long only global. But and there's some reasons for that. There's some high barriers to entry trying to do a global asset allocation platform. It typically are firms that are actually global, like located globally, you know, not necessarily US, or if they're US domicile, they have offices all over, and they're able to really drill down and be able to make those tactical moves. So,
so I guess I'm comfortable with if we could come back with just a recommendation between these 3 and tell us, given our all the adjustments we've made to our portfolio, which one at this point in time is going to complement or have a low correlation to any of the other managers that we have in our portfolio going forward, given that when we implemented this, you know, back starting in 2006, that we had a very different structure back then. So if we can take these 3, come up with an analysis and then a recommendation, I would like that from my perspective, and let me know if any other trustees agree or disagree.
Yeah, I mean, that's why I was wondering about another firm that might fit in this category, but I'd go for, you know, as you said, Christina, just, you know, really understanding, you know, if it is going to be PIMCO, you know, that correlation to all the other funds that we have. So, I mean, that sounds good to me.
your hedge fund, total hedge fund at the 1 year at 12.5%. You know, Grosvenor did wonderful. White Box is a multi-strat fund. They, you know, have a multiple assets with, or multiple strategies within their portfolio. So they did do about 5.3. That interest, you know, while it's flat, we're really waiting for that final redemption. So we're really out of that. So that's not really counting too much towards your performance. Okay, we can move forward. And then on the real estate did fairly dismal on the long only, or the REIT side, you know, the open-ended is what I meant to say. The UBS Trumbull, that's something we've been struggling with for a while. It's exactly why we got into big real estate and Elm Tree. Elm Tree is not showing on here any longer because we were able to do extraordinarily well, and that's closed up. And so now we have re-upped to Elm Street. So it's just not showing as of yet, as we're looking to fund that. So we're continuing to make strides on the real estate front. We will likely come back a little bit later in the year with some other options. Big real estate right now is a fund that will be coming back to market as well. And so that's on the real estate debt side. And then of course, Elm Tree, which we just approved, is on the triple net lease side. So both of those are the non-core segment. And again, we're really looking to increase the non-core portion of your portfolio in real estate, reducing the core. Core, of course, just doesn't generate as much from a return standpoint, as well as it's been hit a little bit harder, I would say, given the pandemic relative to the non-core managers that you have worked with, and again, and will be working with.
Kristen, and board trustees, I just wanted to update you guys with Elm Tree. So the documents are being reviewed by our attorney. There's been some discussions with the Elm Tree folks. So just probably about 60 days from when we started, which was last month. There is a closing in April. So if everything can get together, maybe we'll hit that closing in April, but the final closing is in June. So that's obviously the target for us to be done before that final closing.
And Elm Tree is part of the real estate category?
Yes.
Okay.
And then the private equity, private debt, all of those are lagged performance. We usually have a separate report that we go through quarterly that goes through the internal rate of return, which is the more appropriate benchmark for these managers. So you see a lot of zeros because they just haven't actually been updated, which is typical for the month. I mean, that is sort of the cross you bear when you're in illiquid assets, but they do generate you know, more performance. I mean, you look at MC Credit, which we actually got into almost a little over a year ago now, right? Well, we interviewed them, I should say, a little over a year ago, not knowing that we were going to go into the market that we were going into, and MC Credit is primed for the type of market that we're in right now. So as you can see, 32%, which is great. But we do have on a quarterly basis a more detailed report that shows you, you know, vintage year and them against their peer universe. And again, from a private market standpoint, which is more appropriate. I think that's the last page, right? Yeah, so these are just the cash flows. Yes.
So why do we have so much cash in that Arch cash account?
The total cash, the 2.8%.
Well, I guess I'm looking at the market value of, isn't that 25 million?
Oh, 25 million. Yes, it is, but it's only about 2.8% of your portfolio. So
is that for the payout of benefits?
Yeah, all of that is for, yeah, yep. And then because of the way the markets, you know, just with the volatility of the markets, we did start adding a bit more cash. So typically you have about 2%. We had gotten a little higher, and some of my clients had gotten up to almost 4%. That's not necessarily needed at this point, but just from perspective, the concern was that markets kind of shut down and you weren't able to liquidate in a efficient manner. We don't ever want to start, liquidating when we're below market. So then that starts to be like a fire sale.
And Angie, remember, we also eliminated a manager and took that money into cash in the fourth quarter in anticipation. If you recall, and we didn't redeploy those assets.
And how much was that?
That was like, Sue, was that like 8 or 9 million?
Yeah, it was a little over 9 million that we did the liquidation at the end of October. That was LMCG.
I was going to say LMCG. Yeah.
Mhm. Yeah, and then we added, usually we are a little higher in cash, I think this time of year because of the contribution, how it comes in the beginning of the year, but we're getting ready to spend about 9 million of that in a week. So
How much do you spend about a year in your payouts and expenses, Sue?
pensions right now are running about $9 million
Okay, about
a month.
Okay,
Yeah.
a month. Okay.
So we anticipate about 100 and what is it? 120, 50 to 20 million?
Something like that, yes. Mhm.
And just one question, under your private equity, you said that report comes in quarterly versus in these sessions that are not quarterly.
Yes.
Okay. And who manages your private equity? Do you know? I mean, I'm sure you know.
The managers, you mean?
Uh-huh.
Yeah,
How
so
many
right
do you have?
Oh, I think we have it listed here. We have a number of managers. I mean, your program is actually mature. So since the 90s, I think. So I just don't have that off the top of my head. We listed the private debt managers because that's a more recent addition to your portfolio. So we, but it's, so do we have that listed? It may be.
We do. And Regina, we can, if Sue can't pull it up right now, she can send you the last private markets or private equity report. So you can know what it looks like before we have our next meeting.
Okay, great. Thank you.
Will do.
Do you have any more questions? We can, what's the next page? I can. I think that's it.
So we want to go to the recommendation.
Yeah, for the private credit.
Uh-huh. Yeah, do we want to do that?
Yep, we can do that. Actually, you know what, Sue? I just realized, I'm sorry. Christina actually wanted us to go to the watch list first. My apologies.
I thought we were going to do this one, then the watch list, but
Well, Christina?
No, let's do this first because Angie has to jump off.
Sure. Okay.
And so I want to make sure that she's on this call before she jumps off on this section.
No worries. So we can go to the next page. So this just is a background. I like to always give you a background of what we're done, what we're targeting. We have a 3% target, and we did start this a few years back. So we're looking to get fully achieve our 3% target in 2025. As a reminder, because this is a drawdown structure, we do invest more than the actual bogey because at any one time we're going to it's just a slower drawdown, A, and then B, we could also be getting assets back. And so to try to actually get to that 3% target, you have to overcommit. Not as much as you need to overcommit for private equity, but definitely for private credit, it's you do still need to allocate. So right now your program has about 3% in it. And so the breakdown now is 3% in mezzanine and 97% in direct lending. So the next component here is going to give you the names of the current managers. So you saw this on the previous page, but what I wanted to show you is, you know, what that vintage year was and what it represented. So the mezzanine was Smith Wiley Grant, which is a name from the past, if you will. That was, I want to say it was probably early 2000s or late, yeah, probably early 2000s, if not late 90s, that it actually was invested in. So that would have been what that mezzanine is. And so it's still rolling off. So the majority of your program at this point is private debt, direct lending, which is senior secured lending. Great opportunity to generate returns. And it also creates a cash flow back. So this can give quarterly or semi-annual returns back, income stream, if you will. So that's what we're in now. The recommendation, and we did a pacing plan, and so it may make sense to send over the pacing plan to Regina, but we did do a pacing plan that really determined what and how much in all the private markets actually, but in particular, since today we're talking about private credit, how much private credit we would be allocating to a year. And it takes into consideration cash flows in and out, how mature the program is, your growth rate, and et cetera. So it's a lot of components to it to determine that. And today, so at this point, we're looking for 10 million to go into private credit for 2021. The three funds that we have are Bain Capital Special Situation Asia Fund. You do not have any Asia exposure. It's a great opportunity. Our write-up is a little light, and I say little light from the perspective of we're still waiting to formalize our recommendation on that. But I wanted you to see it so that you knew it. It is slated for a 1 rating. And the process at NEPC is once we've gathered all the information, met with them, got all the data back, then it goes on a schedule, if you will, to actually be approved. So we're anticipating this is going to be on the schedule in the next month or so. And at that point, it will receive a 1 rating. But I wanted, again, to bring it forward. It's probably going to close really quickly, just because it's a high flyer. And so it does, it's going to provide or could provide, should you be interested in putting this in your portfolio, a component that you do not presently have. The second one is Crahill Principal Strategies Fund. This too also is niche private credit. And you'll see when we go to the next page, I believe that I have sort of kind of what we like more, if you will, and the private credit. Private credit continues to be an area that we think is going to do very well. And then MGG Specialty Finance. Oh, let me stop for a second. I also need to mention that Crahill is a Latino-owned firm, so that does meet sort of some of the goals, I should say, as it relates to continuing to include diverse managers. This is a preferred manager for NEPC. We like it. You know, they bring a lot of complexity, and complexity is what is really being the difference between what I'm going to say run-of-the-mill managers and managers that are doing really well. And then you have MGG Special Finance Fund 3. We like them a lot. They are private debt, though, or direct lending, which is what you have a lot of that. And so in your portfolio, so I wanted to bring a third manager in case you didn't like the Bain idea. You know, sometimes people get a little nervous about Asia. We think it's a great area, but you know, I just have to be mindful that you know, give you options to think about. So MGG would be another manager that we like a lot. That my only issue with MGG is you just have a lot of private debt or direct lending presently in your portfolio. So I think diversifying out would be great. So maybe we can turn to the next page. So this is the schematic that gives you an idea of how we're thinking about private credit today. And so if you can see the US direct lending and European direct lending are gray. Gray is neutral. We like them. Most of our clients have them in our portfolio, but a couple of years ago, they were green. Now we see other areas within the private credit schematic that we think there's more value over the next 5 to 7 years. Niche lending, which is where Crayhill falls, and then opportunistic credit, which is where Bain falls with an Asian bent. So that just gives you an idea. And then there's distressed debt, but we only have 10 million. So wanted to bring you a palpable number. So maybe if you like 2 managers, I would recommend just splitting it, 5 and 5. So maybe we can move forward. This is a snapshot of the pacing plan. So there was a much larger report that we presented here, but this is just a reminder of what our actual pacing is for the years to come. So you can see 2021 is 10 million. Last year we did 5 million. And then each year out, we're, essentially at 10 million. We're pretty close to where we want to be as it relates to that red line, which is the target net asset value. So that's great. We do have to have a little higher than where we want to be to kind of make sure that that's the drawdowns are going to result in us having that 3%. As a reminder, because of the pandemic, drawdowns have slowed a little bit also, and so that's so we're still in good shape, but that's something else that we have taken into consideration. We do this every single year, so while we project out to 2030, if you will, we will continue to do this every year to refresh, to ensure that we're taking into consideration any changes in the market, in the values, and in where we see the opportunities. And so as an example, last year, the opportunities were a little bit different than they are today, just because of where we are from a market standpoint and being out of the late cycle and into what we're calling the virus trajectory. So that's just a little bit on that. And maybe so we can move forward. So these are just the manager profiles. And so again, we've spent a lot of time with Bain. They're Asia focused, which we think is great. The target deal size is about 30 to 100 million. They're going to have about 25 to 40 investments. Very importantly, they have a 7% preferred return. Just as a reminder, that means that before they take any profits, you get 7% back. And so that's why we like these type of structures. We want to see a preferred return. Most of the managers that you work with do have a preferred return. And then the target net IRR, so net is going to be net of any fees that you pay, is 15 to 18%. So. Any other questions? I know this was, you had this.
Would we be in class A or B, carried interest?
We would probably go with class A. I think that's the, oh, no. Class B. Class B has the less, the lower fee. So that's the other thing, the benefit of working with NEPC, because we work with these managers and develop over time relationships, we're able to often negotiate fees for our clients. Those fees don't benefit us at all. They just, they're a total pass through. It's just saying, okay, we have X amount of clients that are going to go into this. We think highly of it, and we'd love for you to give our clients a discount. About how it ends up getting said. And so we work through them. It doesn't always work, but that's a goal that we look to have.
The Asia, the investments in Asia, is it mostly China or is it just Asia in general? Because I just read a report that China is expected to do extraordinarily well for the next 20 years.
Yes, China is. So I think it's all of Asia, but predominantly China.
Okay.
Mm-hmm. So yeah, China is going to be about 18% gross GDP in the next 20 years. I mean, the pandemic slowed it down a little, but it's one of those things, I actually have a chart that I've shown in the past where we have kind of bubbles of expectation. And so given the policy and trade issues that we had, it was either we developed simultaneously and didn't really acknowledge what was happening in Asia, in particular China. And so then you had two different economies going sort of simultaneously, or what was the preference was that they incorporate and we still invest with each other. That's the best of both worlds. But of course, with the past administration, there was just concerns that that was going to happen. And so I think now that we have a different set of policies that are coming forward, that's like, you know, just the recognition. You can't get away from it. China is doing well, they're going to do well, they're going to continue to grow. And so either you choose to invest or participate or you don't. And they have the rest of the world. They have Russia, they have Africa, they have so many other places to go that we could end up getting left behind if we choose not to sort of participate. So again, you don't have any Asia exposure in the portfolio. And I think that it would be, especially at a $5 million level, a great entree, especially with a firm such as, Bain, which is going to incorporate both op credit and a bit of distress, mostly op credit, but still they have a little distressed.
So Kristen, I would say we don't have Asia exposure in our private equities market or private
Right.
markets, but we do have it in our equities market.
Yes.
So, yeah, okay.
I'm thinking, more on the private where you're going to get that illiquidity premium over public markets. So we can turn to the next. So this is Crayhill. They're out of Connecticut, Latino based. They really target bespoke financing solutions. So they have a complexity premium. They are able to keep fees in several different ways, which we really like. Very well structured. Again, not a huge fund. That's one thing that you'll notice about NEPC. And this is nothing against the $4 billion funds, $10 billion funds, but we try to find unique opportunities where, oftentimes these smaller managers, and not that 430 is like itsy bitsy, it's very much institutional quality, but smaller than the $2-3 billion funds, they do tend to have that nimble nature to be able to really generate returns. So this is a firm that Oliver Fadley, a researcher, followed for quite a bit of time. They've done well. When you look at their performance numbers that we have, you'll see that they're top quartile. And, this is another one where we've been able to negotiate a fee. You see that 75 basis points on committed capital. And that's good as well. So we really like seeing that. They have a preferred return of 7%. Net IRR is 12 to 15%, not as high as the Bain, but Bain is a little bit more targeted. This is a little bit more diversified, but it still has non-US exposure with the Western European component.
Now, Kristen, have both of these, Bain and Crayhill, invest to ensure that we're able to invest in these given our mandate? What's that mandate that we have that we invested one time and we couldn't continue because they were offshore?
Yes, so both Bain was Delaware and this is New York City. You're talking about where they have only offshore.
Yes.
Mm-hmm. Yeah. So I did look at that. Don't want to get caught. So yeah.
So this one's Delaware, right? And
yeah, this one's Delaware, and you can go to the previous page, I believe, for Bain. Did we put it on here? We may not have.
Yeah, this one says Cayman. That's what I was asking.
Yeah,
what is it called? UBIT or I can't remember what it's called.
UBIT. UBIT.
UBIT.
Yeah. I'm gonna double check that. I believe I saw on it, but let me just triple check. It's nothing like triple checking it. Let me actually. What time is it? Maybe Oliver's there while we're going over these. Because I believe we talked about.
It does say or Delaware Limited Partnership, which we would need.
Yeah, there it is. I knew I saw it. That's what happens. You start second guessing yourself. I knew I had looked it, but yeah. And then the third one is going to be, actually, before you go back, you can see again, net IRR, the top quartile. I mean, this is a high flyer as well. Really like this fund and what they've done in the past. So, and then MGG, you already have MCC. So this is a very strong firm, high flyer. You know, they have both a levered and unlevered opportunity. You know, I would recommend the levered if you choose to go with it, just to get a little bit more gusto, if you will, at 12%. The levered vehicle has a 7% preferred return. Again, very strong firm. You know, the only caution is that we already have a lot of direct lending. So this is more of an allocation, not so much about the firm. So those are the three opportunities. I know I've talked a lot, so maybe I can kind of get you all's sort of, and you can see their performance, very strong. They want either top quartile or second quartile manager. Thoughts, impressions? I mean, how do we feel about Asia?
I'm
Good.
comfortable. I'm comfortable with Asia. The only thing is, do we have anything that shows what their last fund did? I mean, I see, oh wait, do I see the percentage returns or, oh,
Yes, we don't have that as of yet because it didn't do the final piece, though. You know what? Maybe. I don't know if I can try to see. Is it down? You know what? I don't think I have it at my fingertips. I probably, so because they're such a high flyer, they're ending up getting a lot of looks, even though we don't have that final stamp, if you will. And so their funds have done really well. Christina, I will have that sheet that exactly what we're talking about shortly. Or the other option would be if you would like to hear from them. I mean, it's pretty easy. You can, we can, you know, do it that way as well. Or, you know, I probably can just pull, it wouldn't be from NEPC yet, but I can just pull what their last performance was in their book.
I guess, and I can only speak for myself and I want to hear from everybody else, but, you know, I'm not one to really go out and expand managers just to expand managers number size. But I think that my preference would be Crahill and Bain equally at 5 million each, and would like to see them present, you know, it's easy now via Zoom. So that we can get a better picture of what their past performances have been, because this is all preliminary apples to apples comparison, but I want to see what their fund performances are and where they see the market going in these categories.
Yeah, I think they would both be happy to present. But Bain is the one that's preliminary. Crahill, we've completed everything with, so that's why you saw the numbers there. So
When is Crahill closing?
Crahill will be, I think, closing the second quarter. So
Second quarter this year?
yeah.
I see. And also, is there a reason why we didn't continue with any of the fund managers of the last instruments that we had?
So for the private credit, you have a lot in Monroe, which we still continue to like. They are private debt. So we're really just trying to diversify from an allocation standpoint. And that's why you'll notice there's some follow-ons actually.
So we're adding to portfolio. Okay.
Yeah. And Regina, we have a policy in place that really, when we look at our fund managers, we try not to have a concentration percentage wise. So that's why, and then we also like to see new and fresh and up and coming managers. So we reward like Elmtree, we rewarded them with new money because they had done so well for us. And so I just want to hear from others if they'd like to see them these two managers present, and if you're in agreement at the next meeting.
And our next meeting is April 15th.
And Sue, is that before the general meeting?
Yes, right before the regular board meeting is April 19th.
And the reason I ask is because if we do decide, then we would take it from investment committee to the general meeting and not have a delay in timing. That's why I was asking those dates.
It sounds good to me. You want to get a check with everyone else and see if they feel okay with it?
Yes, so
I would love
Bobby,
for everybody to, I would love to see a presentation.
thank you,
Okay,
Albert.
Al.
Anybody else?
I would
I'm
like to
okay
see,
with it.
well,
Is there anyone that doesn't want to see it?
Good with a presentation. I just wanted to ask about Cray Hill. If they're closing at second quarter, is there a chance that they would close once they reach their funding max and then we miss out on that? Asking, I
Yep,
guess.
so yeah, so what I do is now that I know that you all have interest and we're just doing a presentation, I let our research team know who's in direct contact with them. And so because of our relationships, they'll look to sort of reserve, if you will, capacity. So, we've even had situations where they've waited. We try to, you know, I try to time it, like, so there may have been some other managers, or they have been managers on the past where I'm like, there's no way we're not making that. There's no way, because I know, what our, the legal time is, but this I thought made a lot of sense. And, Cray Hill initially had a I think they had a first quarter close. But again, because capital's been harder, I mean, there was a period of time where people were just afraid to sort of move forward. So this opportunity probably came up towards the end of last year, maybe the fall. So they're winding it up, but usually they're fundraising for a year. So, but I will be, before, it may even happen before we get off the phone, I will be emailing Oliver and letting him know that we need to go ahead and schedule them for, our April 4/16.
April 15th,
Oh, thank you, tax day. Okay.
the old tax day.
The old tax, right? Got an
That's right.
extension,
It was
right?
May. Mhm.
That was weird, right? People thought it was going to be more, right? It's just, it's almost like it's just
Didn't they postpone
payment.
tax day?
Yeah, for 1 month.
It's
1 month.
that much.
May 17th.
Yeah.
So, okay. So so I think the direction at this point is to bring Cray Hill and Bain in. Oopsie, Cray Hill and Bain in. Yeah. So. And then Angie, I will try to go over this other really quickly because I understand you have to go.
I still got a good half hour. I'm good.
Oh, well, we've done good then. We got things pretty succinctly. So I think the next thing is just the watch list, or the due diligence report, I should say. Okay. So this is really just a scorecard, if you will, kind of, or to tally up where we think performance is, to make sure we're in line with our policy, that we're reviewing things. While the numbers are fairly absolute, we still put sort of common sense to things as well, because you can make a mistake. You see these red yeses and you say, well, okay, do we just terminate everybody? The answer is no. And I'm going to take Edgar Lomax as an example. They had a terrible year last year, but prior to that, they were like for 5 years, were one of the best performing managers. So you have to then, this is just a guidepost for us to really understand what's going on, why it's going on, and making sure that we're sticking with our policy, which does suggest that if we see a manager that's not doing well for a period of time, that we start to think about bringing them in to get some understanding as to what's going on. And then the result of that could be a terminate, it could be a hold, and continue to watch, depending on that answer. And so what I think stood out to me when I reviewed this is, you look at Q1 2020, everything went crazy during that period. Pretty much every single manager did poorly during that period of time. And that obvious, again, going back to the commonsensical component of this, that was when we had the March was when we almost went into a recession. So that's the result. But I think the most important thing to note is while we look at it monthly, we look at it quarterly, we also have this review where you can look and see, okay, how do the numbers look for each quarter? first, second, third, and fourth, and then over the 2-year period. And this aligns with what's in your policy as it relates to the checks and balances of your portfolio. When you look at the watch list criteria, it says managers met or exceeded their respective index for 4 quarters and peer median. So that's in your policy. And then manager has met or exceeded their respective index and peer median for rolling 2-year period. That too is there. So that's, the things that we're looking at that this performance rolls up to. And so then the last column is a simple yes or no, whether they've passed or failed. And so now we have a number of managers that would be recommended for watch list. And so, the policy would suggest we put them on the watch list. I'm not overly concerned with these managers because I recognize when exactly this performance happened. This is not something that's been persistent over long periods of time. Again, Edgar Lomax had a pretty poor year last year, relatively speaking. But when you look at their history, you look at that calendar year performance over time, they have ended up being one of your best managers and adding significant value over the last 4 years. So that's not to say we fall in love with a manager, but we do have to look at it from a broader framework. Otherwise, you could end up putting yourself in a position where you sell good managers because every manager, what do we say? They have their day in the sun and they have their day in the shade. That is just the reality of the markets and managers. So that's a pretty kind of succinct, high level what this chart does, but it does give you a quick and dirty way to, say, hey, what manager should I be asking about as I think about going through the report? Because the reports, especially that quarter report, is pretty large, and what to keep on the mind that we want to look at over time. I mean, TCW is an example. That's a manager that for a while we thought was going to be on the watch list, and despite their poor performance quarter 1, they don't meet the qualifications.
I want to comment just one moment while I get in the car.
I'm sorry.
A general question while she's getting in the car. On the criteria, it speaks of peer median. Can you explain to the group what that means?
Sure. So if you take like Russell 1000 value managers, there's probably somewhere around, it's probably close to around 300, let's say 300 managers. Okay. And so that's going to be their peers. Different than the index. Index is passively managed. So let's call it 300 and just say 300 active managers that invest in this specific style of Russell 1000 value. And so then you can rank those managers. And so when you say, so that would be them against their peers. And then if you're going to take their peer median, it's just going to be the median of the peers. And how do they fall?
Okay, Krista, sorry about that.
No worries.
So what I'm looking at too is a couple of things. Is when we used to do this watch list. I guess what I'd like to see is the quarters as they go, so that we can see all 8 quarters like we used to, and then we can see where a manager either went under or whatnot. Now the watch list talks about the index. But it doesn't talk about negative performance, right? So that's why we want to look at the quarters and then look at it at the benchmarks over time, over those 8 quarters. But we are in a very different financial situation than we were 3 years ago, 4 years ago, because our benchmarks are beating our performances. So a lot of these managers are going to, if that continues in the short term, are going to be negative. They're going to fail that because they're not going to exceed the benchmark, right?
Mm-hmm.
So while we see red, we have to look at the overall picture of what the markets are doing. But this gives us the tools to say, we know what the market trends are doing, and our benchmark or our policy has been in place to catch the opposite, to catch those managers who are falling below the benchmark, and maybe performance as well. So I like this list because we can track it as we go, and then we can turn around and make that decision. If it's also performance and not just benchmark, historically we've been able to bring them in
and say what's going on, what has changed, what policies changed, what managers have changed, what's going on that we are not meeting the benchmark and maybe not performing as well. So this is why it was important for us to look at this, educate ourselves on what's in our documents, and then be able to manage to this report and make those decisions that we need to make if we have to from the fiduciary side. So we can work on this and educate ourselves as we go through this as we go. But I wanted to just get your opinion as different trustees to see if this is something we should incorporate every quarter in our meetings.
I remember looking at these watch list reports and, it being the, I guess, 8 different quarters. I guess I'm a little bit confused now about the performance versus, the benchmark. I guess I have to go back to an old report and see what the difference is. But I do recall, things like looking at those 8 different quarters and being able to see over that span of time what that performance has looked like, which I really like. And when things change, I really kind of miss that. So I think I'm going to have to go back and look at one of those older reports.
Right. So, and just for clarity, that 2-year number, that is going to be that 8 years, right? Or, 8 quarters. So there's 4 quarters in 1 year. So 2 years will have 8 quarters. So it's just not, you're probably trying to fit it all on one page, actually. So,
It seems
that
to
makes
me
sense.
Yeah, I guess it seems to me, and I have to go through the policies. I went through them briefly. It seems that as we do the watch list, 8 quarters seems to be a short-term look at the data versus something maybe a little longer term, maybe at least 5 years, only because if you have if the market goes down tremendously, even for 6 months, it's going to probably have an impact for probably 2 years. So it takes a while for the market to get back up. And I guess also when we're determining watch lists, if you know of specific things that really impact the manager, we should probably know that, because sometimes a change in manager will impact the fund for a little while. And maybe that data, in addition to the numbers, would be helpful. Obviously I wouldn't want to change the time frame for which we look at the performance if it's in the policies, in our policies. But I've certainly seen a much longer term when I served on other investment committees to determine watch lists and things like that. So it's just something for consideration.
So our qualitative review is what Kristen has been providing, is a change in manager, somebody leaving, a lawsuit, all those things are updated on a regular basis. Mm-hmm. We used to do this quantitative review just so that we could balance that out. And then from my tenure on this board, we have eliminated maybe 2 or 3, but it was truly for performance or just dissolution of the managers, but only 2 or 3 for true performance. And we, just because this is a 2-year look at, we also we track it so we know. And then if we feel that they are just losing they're switching their mandate a little bit too much than what we agree to, then we bring them in. But we've never used this as a, hey, we got to get rid of them. We've used this as a discussion to bring them back to the table and just say what's going on, because this is 2 years now. And we've done that quite a bit with a few managers. And I think, what was it? Causeway was one of them. I think Michelle Kamen, Michelle's, what was her, Wellington was one of them, and then what was the other one that Michelle had? Clayman had. Kristen.
New Amsterdam, is that who you're talking about?
New Amsterdam, yeah, New Amsterdam one was one where they had been in our portfolio forever, and we brought them like twice back to the table, and then we ended up. It wasn't so much that they were just losing money; it just that they were performing so far beneath the benchmark. They couldn't change enough and so we moved on from them. But this is just a quantitative tool to just give us the ability to track this in addition to everything else that we see.
Right. I just think 2 years as part of the quantitative tool might be too short, but it's just something for consideration.
Yep, I agree. And the quarterly book that we have looks at things at the 5 and 7 year time horizon. So this is an additional overlay that, more from a watch standpoint, which again, as I, highlighted sort of that first quarter 2021, the fact that everybody was red, it puts to question. I mean, you got to kind of wrap that common sense. We're not looking to, it's not best practices to me making decisions on managers inside of 3 years, quite frankly. It's more of a 5 or 7 year time horizon. But, the board has been comfortable understanding what's happening in the interim. And so that is what's led us to sort of this process.
I agree, Kristen. I totally agree. But I'm glad that we're having this in front of us and having this discussion. And Regina, always open to looking at the guidelines and looking at with fresh new eyes and providing recommendations where we see we need to make changes. So, thanks, Kristen, for having the staff put this together. I just think it's another tool in our pocket to be able to look at it, and gives us the ability, if we were ever to be asked why do we continue to have XYZ in our portfolio? I don't think anybody, watches these as closely to ask any one trustee, but at least we have the tools to be able to pull up from our emails and be able to answer that question and get back to somebody, especially those who are elected and they may interact with more people than the rest of us do. So I appreciate the staff being able to do this in a quick turnaround time. Is there anything else on the agenda that we need to discuss?
I just wanted to talk for a minute about pensions and investments, that subscription that we have.
Yes, please.
So it's really been kind of difficult to get with them. I don't know if they're changing their focus, but they have our subscription actually expired in November. We had a 1 year subscription, never received anything from them. So they have this new tool. So I've been, since we met last and this came up, I've been trying to get with them and figure out what's going on. So they have this new tool. They still have the printed publication. So if we wanted to move forward to get a subscription to everyone, to all the trustees for the printed publication that actually comes out bi-weekly, then we can certainly still do that. And that would be about $3,100 for everybody. Then they propose this tool, and there isn't a way to just do the online version of the printed publication. That is crazy expensive to do that. That's like $2,000 per subscription to just get the online version. But they have this new tool called P&I Pro, and here's what you get with that. You get basically the online, you get the printed, plus you also get kind of their research center where you can go in and do a lot of research, which I thought, that could be helpful for, some discussions. But this is only available on a enterprise-wide basis. It's not per individual, like we can do the subscription for individuals on the printed publication, but this is available to everyone. And so the cost for that would be about $4,300. So we'd be spending, $1,200 more. We get more, but I'm just not sure how interested everybody is in getting everything. Now, what they've told me is if we subscribe to this, if somebody doesn't want the subscription sent to their home, they can shut that off. If they don't want the daily emails, they can shut that off, and then they can just go in and get those things. So this would be a more robust tool, but it would also be more expensive.
Yeah. Now, let's just take a call. I mean, I still have access to my online version. I don't know why, but I log in and I get my emails and I'm able to search and do whatever I want. I don't know if they've just forgot about me, but I basically use this and I read it, and this is like my bedtime reading. So again, I'm not the average person. I love reading what's going on, but I don't know if other trustees, pitch it, recycle it, ever read it at all. I don't know if this is something that is of interest to everybody, or if there's another publication that might be of interest to other trustees. But I don't necessarily have to have this until they kick me off my online. I can find it other ways. But I just wanted to hear back from everybody else if they actually read it.
I read it, but I like the new version that gives the whole scope, and you all, each trustee can opt out or opt in to whatever portion of it that they like, and the additional $1,200 that seems to be okay if we're getting more bang for our buck. But again, that's a collective vote, and so I need to know what everybody else thinks.
Susan, I'm not sure if I get it, but I suspect if I do, it goes to my cell phone, my email with the school board, which I don't look at that often. But is there any way you have it go to my personal email, or is that something that can't be done?
Yeah, I mean, whatever, we'll set everybody up however you would want to get it. Yes, absolutely.
Great. Thank you.
Yeah. We need to hear from the rest of the game. Of the trustees. See what you all want to do. Yeah, go ahead. It's your chance, Al.
Okay.
Take it all. Take it in.
I'm going to say I don't even. Who does it come from? Because I don't ever remember getting it, but I would love to get it just to get more familiar with this.
Okay.
Get more familiar with it. But who would it come from? Who does it come from?
Yeah, well, actually, as I look at the list that they sent me, the reason you never got it is you're not on the list. I think it was renewed right before you came on the board.
That's right.
Because it was renewed in November of 19. And so I guess it was never updated. So that's why you never saw it.
Okay, that's what I thought. I was like, I look at most mail except junk, but yes, I think it's something that as a trustee, I think it's important that we know something, and it'll help us just know a little bit more about the process of what's going on in the market, I believe. And if it's just for a year, we can try it for a year for the ones who are on, and then if nobody uses it or it's not worth it, then don't renew it for the next year.
Hello.
Yes, Sheila.
I have so much to read and I can't keep up with it. So I just prefer to keep it simple and just get the newspaper.
Yeah, and you could do that. I mean, if the decision is to go with the bigger tool, you could do that. Sheila, we could set you up just to get the printed, and you wouldn't have to get like all the daily emails and things like that.
Okay.
So if you get the newsletter, the daily email, will that information be in the newsletter?
Yeah, it's going to be now I haven't seen the daily ones, but the publication has kind of what's going on in the industry, who's going out for searches, new managers, things like this. I get other daily emails and it's like, hey, here's this that's happening. You know, it's more like in the moment kind of stuff that would be in that. So my guess is it's going to be more than what's in the newsletter, the printed publication.
Because I was wondering, will it be duplicate? You know, getting the daily email, then you end up getting it's duplicate.
Some stuff is duplicate, Bobby, but like Sue said, the articles that are in the publication.
Chrissy, your phone is cutting off. You're away from you have to get closer to your router, I think. Can't hear you, Chris.
She sounds like she's singing a song.
Right. Right. I think she's away from
hired or
that was a remix.
Yeah, Chris, we couldn't hear anything you said.
She's not talking right now. But I think probably what she was saying is that
more.
That's her talking. She's trying to.
Which means she probably can't hear us either.
No, she can't hear us.
I would say it's probably more. I think she was going to say like the daily stuff is going to give us a more updated version of everything that's going on constantly. Exactly. Whereas the print newspaper, they can't put everything. Like if a company goes down yesterday and they already have it in print, they're not going to print that in the biweekly newsletter because they just can't do it that fast. Where the daily email, you'll get that to say this company had this thing, but the newspaper gives you an overall view of what's going on and probably more in-depth analysis of certain companies or certain managers at the time, whereas the daily just tell you everything.
Yeah, one of the I like the pension publication, but I also wanted to see if we could get the St. Louis Business Journal. Because that gives us local information about the ifs, ands, and buts in the marketplace and everything. I had that once before, and it's very well written, I think. So, yeah, but anyway, we're talking about pensions right now, and yeah, I'm for it.
But just to tell you, Louis, I did reach out to the St. Louis Business Journal, and I haven't gotten a response. I did this, a couple weeks ago, but it goes to some, because there's a compilation of business journals. It's not local that does the subscriptions. So I actually haven't heard back from them yet, but I will follow up on that because that shouldn't be real expensive. I wouldn't.
No, I don't think so. Yeah. So are there any trustees, since Chris is out of pocket here, are there any trustees that are there trustees that like what we're talking about doing? And if so, we can go on and try it.
I agree. I'm interested I would like to try it.
Okay, because the whole focus was to become knowledgeable about the financial processes. And so I think this is a good tool. And so, okay, then if we can get
let's move forward. Yeah, let's move forward, Sue, with the enterprise one. And I guess you can send us an email individually of what our options are, and we can return and respond what options each individual trustee would like. They can respond to you individually.
Yeah, we'll work on that. But yeah, and the other nice thing about it's unlimited. So if we want to add more people, once we get this enterprise, we can have as many people as we want. So
even the ones who were voted in December of 19.
That's right.
But also, Sue, I would like to use this for your staff as well. I'd like for Terry to start reading it and getting it, so that you can use it as a training opportunity as well for your staff.
Yeah, and he used to get the printed publication, the pensions and investments. So yes, that was definitely, I wanted to share that with him as well.
Michelle.
Okay, if we have no other business, can I make a motion? Can I get a motion to adjourn?
I make a motion that we adjourn this meeting.
And Richardson second.
All those in favor say aye.
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 Aye. All right. Thank you, everyone. I thank you for putting up with my inability to stay focused today and to stay actually vocal because I heard I was singing.
Yeah.
You
Yeah,
do a
but-
remix.
Yeah. Thank you all so
Alrighty.
much.
Thank you,
Bye-bye.
everyone. Take care.
Thanks,
Bye-bye.
Sue.
Bye.
Bye, everybody.
Bye-bye.
Bye-bye.
Okay.
Thanks.
Bye-bye.
night.
Thank you.
Bye-bye. Bye, Sheila. Take care.